In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about how hotels as an industry can act as a proxy to tell us about India's growth as a whole. And in the second story of the day, I'll talk about the first advanced estimates for GDP growth in India and why they really matter for someone like you or me. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 9th of January. With that, let's begin with the first story. Look, ICRA, a company which analyzes multiple different industries, has recently issued a note saying that hotels in India will probably see their highest earnings per room in a decade by FY 2025. And it's not just in FY 2025, it is also expected to continue growing even in 2026. And now I know this might sound like a business story to you at first, but this also carries a much bigger meaning for our economy at large. So in order to understand why it matters and what's exactly going on over here, let's start with the very basics. Look, there is a metric in the hotel industry called the revenue per available room, or RevPAR. Now, this is a measure that tells us how much money hotels make from each room every single day. It takes into account two things: the number of people staying and the price each one is paying. Now, when RevPAR is going up, it suggests that either more people are booking rooms, the rooms are getting a little more expensive, or both of these factors. Now, in the current scenario, both of these things seem to be happening in India. Occupancy levels are expected to climb to around 72 to 74% by the year 2026, and the average rate for a room in a premium hotel is expected to go as high as 8,000 to 8,400 rupees. Now, these numbers in a way act like a proxy that people have more money and they are ready to spend it on non-essential items like hotel rooms. Now, of course, hotels are not just for a basic need of shelter. People also book them for weddings, for their work trips, for their holidays, conferences, or sometimes even for a general break. Now, therefore, when the occupancy levels are rising in hotels, they can charge more, and it usually means that people are more comfortable spending on travel and leisure activities. Also, when businesses are hosting events, conferences, and also sending their employees on work trips, it shows that more corporates are confident about spending in the economy. Now, all of these are positive signs for the overall economy if you think about it. Now, with that said, another important element in this story is tourism. See, domestic travel within India has bounced back quite strongly after the pandemic, and also foreign tourist arrivals are on the rise quite a bit. To give you some context here, there were about 10 million foreign travelers back in 2019. Now, of course, the number fell sharply during COVID-19, but since then, we have recovered to about 6.2 million as of 2023. Now, of course, it's still not back to the pre-pandemic peak, but the numbers are certainly improving quite fast. And on top of that, the government has built 17 new airports since 2020, which has made it very easy and also cheap for people to fly into the country. And this increased connectivity has boosted both local and international tourism, which therefore has kept hotels busy as a result. Now, within the hotel world, you can broadly divide players into two groups: branded and unbranded. Now, the branded side includes well-known names like Marriott, Lemon Tree, IHCL, which is by the way the Taj group of hotels, and a lot of others. Now, they have roughly 166,000 rooms right now in India, and they plan to add around 55,000 more rooms in the next 5 years or so. Now, the unbranded segment is much bigger, but the thing is, it's a lot more scattered. And in case you're confused about what an unbranded hotel could look like, you can imagine them as small family-run guest houses or even Airbnbs for that matter. Now, because they are so spread out and diverse, it is very difficult to track their performance in one solid number. But what is especially interesting is how branded hotel chains are switching to an asset-light approach now. Now, instead of buying and building properties as a whole, they are signing deals with property owners in order to manage or franchise their hotels under their own brand. This way, they don't have to spend huge amounts of money on real estate or construction, which obviously can take many years and could also involve a lot of red tape. So by focusing on running the hotels instead of owning them in the first place, these particular hotel chains can add more properties a lot more quickly, and they can also keep their financial risks much lower. So now you might be wondering, if people are booking hotel rooms so much, why are hotels not popping up all over the place right away? See, the issue is that building a hotel takes a lot of time. Developers have to acquire a land first, they have to secure permits, and then construct the property. And all of these can stretch over multiple years in a country like ours. Now, prime spots in big cities are especially expensive and they can also be very hard to find. So, this delay means that the pace of building new hotels can often trail behind the growing demand, which could cause room prices to rise quite a bit and also, as a result, boost RevPAR even further. Now, the final part to consider in this entire story is the shift to smaller cities, which are also called Tier 2 or Tier 3 markets. Now, for a long time, hotels have majorly focused on major cities like Delhi, Bombay, Bangalore, etc. But now, because of better roads, airports, and a rise in disposable income outside metro cities of India, hotel chains have seen a big opportunity in these smaller cities. And therefore, they're opening many new properties to tap into local business travel, weddings, and even tourism. So if you summarize everything together, when hotels do well, it usually lifts many other parts of our economy. More hotels, of course, means more jobs for people. It could range from front desk staff to chefs to construction workers and even taxi drivers for that matter. And more tourism means that local shops and restaurants also earn a lot more, and overall cities become a lot more attractive to investors. And for an analyst like me, it is a very useful sign of improving consumer confidence and business activity in our country. And for everyone else who is just looking at it externally, it usually means more enjoyable travel, easier access to new places, and thriving communities which benefit from all of this growth. With that, let's now move on to the second story of the day and talk about India's GDP. Look, recently, India's Ministry of Statistics and Program Implementation, which is also called MOSPI, published the first advanced estimates for GDP growth in FY 2025. Now, GDP, for those of you who are new to finance and the markets, is the value of all the goods and services that are produced within a country. And therefore, it makes it a decent way to measure how big or small our economy is and also whether it is growing or shrinking. Now, calculating GDP for some of you might sound simple. Just add up what everyone produces and you get the number. But the thing is, in reality, it is fairly complicated and it involves a lot of data gathering. And to give you a sense of how tricky it is, the government actually releases 6 different estimates of GDP for every financial year over nearly 3 years. At first, they come out with early numbers called advanced estimates and provisional estimates. Then, as more and more information becomes available, they revise these figures and publish what is called the first, second, and third revised estimates. Now, this step-by-step revision happens because in the beginning, the government only has partial data to look at. Now, over time, as more and more companies and sectors start submitting their final reports, these numbers become a lot more clear and accurate. So then you might question why even publish estimates so early if the data is not complete? See, the real reason is that the government needs a very quick sense of where the economy is headed so that they can decide how to plan and spend their money. See, if everyone waited almost 3 years for the final numbers to come in, it might become too late to make the right policy changes. And that is why these advanced estimates, even if they're not perfect numbers, are still very, very important. So with that context in place now, let's take a look at this particular year's advanced estimates. Now, according to the new data, India's real GDP, which is by the way the GDP after removing the effect of rising prices, is expected to grow by around 6.4% in FY 2025. That is lower than the 8.2% growth that our country recorded last year and a little lower than the Reserve Bank of India's earlier estimates of about 6.6%. Now, when I say real GDP here, I'm talking about adjusting for inflation so that the growth in pure production and consumption terms can be compared without the effects of prices going up. Now, the slowdown to 6.4% is not so surprising also because many economic indicators like factory output and services data have already been showing some signs of weaker growth in the country. But the real excitement, or maybe worry in some cases, is usually hidden beneath the headline growth number. Now, one area that stands out is the performance of the manufacturing and mining sectors. Both of these sectors have seen a drop in their growth rates. Manufacturing went from about 9.9% last year down to 5.3%, and mining, on the other hand, slipped from 7.1% to 2.9%. Now, this is important for us because it runs counter to India's aspiration of becoming a major manufacturing destination for the rest of the world. Also, mining is a part of the country's core industries and it can affect many other sectors. But meanwhile, on a good note, agriculture grew by about 3.8%, which is a great improvement over last year's 1.4%. Government spending on public services like health and education also grew faster and they moved from about 7.8% to 9.1%. Now, this makes sense because rural demand has been slowly catching up with urban demand, like we've discussed multiple times on this show, partly due to better agricultural performances. See, if farmers earn more or if agriculture benefits from good weather or government supports, rural families have more money to spend, which then boosts overall demand. Now, another important number to look at is what we call gross fixed capital formation. Now, this measures investment in things like factories, machinery, roads, buildings, and so on. Now, it went up by 6.4% this year, but last year it grew by 9.0%. Now, this drop says that both government bodies and private companies are not quite investing as aggressively as we might like it to be. One explanation for this could be that the governments, both central and state governments, are spending more on running costs like salaries and administration than they are spending on big infrastructure projects. And if the government is not investing enough, the expectation is that private companies should fill the gap, right? But this doesn't seem to be happening at the desired pace right now. If investments remain weak, it can hurt long-term growth because newer factories, roads, and technology often lead to higher output in the future. But on the bright side, private consumption, which is the amount that regular people like you and I spend on day-to-day goods and services, has done a little better. It grew by 7.3% in real terms, which, given that it accounts for more than half of India's GDP, helps keep the economy afloat in a certain sense. But there is a twist to this story as well. Consumption growth is not the same everywhere. Rural spending seems to be improving faster than urban spending, partly thanks to stronger agricultural sector like I just mentioned. And that's of course good for the rural part of the country, but if the city markets pick up as well, overall consumption could get another big boost. Also, imports show a pretty interesting pattern here. In real terms, total imports of goods and services actually went down by 1.3%. But in nominal terms, which is the raw numbers without removing inflation, they went up by 9.9%. This suggests that even though India bought fewer items from abroad this time around, each purchase costs a lot more, possibly because Indian rupee became weaker against the US dollar. Now, the Reserve Bank of India, of course, intervened to keep the rupee from losing too much value, but without such action, India's import bill could actually have been much higher. Now, let me remind you that it's worth keeping in mind that all of these details come from the very first set of advanced estimates of this year. This data may be revised later when more complete information arrives. So these numbers are not the final word on how our economy is doing, like I earlier explained. Research shows that these early figures can a lot of times actually underestimate the true growth rate, which can be much higher once the full picture actually emerges. But still, for now, these pictures can paint a good snapshot of our economy. So to summarize, manufacturing is slowing down, mining is facing some challenges, investments are not as good as we'd like it to be, and consumers are carrying a good chunk of the load with their spending right now. Of course, policymakers, investors, and businesses will be watching these trends very closely because if one part of the economy starts to stumble, it can actually affect everything else as a ripple effect. We'll only know how accurate these figures are once the government actually publishes the revised estimates, but in the meantime, these advanced estimates are still very valuable data points for us. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, the Ministry of Heavy Industries in India has put forward a plan to lower the GST on CNG-powered two-wheelers from 28% to 18% and then eventually to 12%. The main goal here is to encourage more people to switch to CNG vehicles in line with India's environmental objectives. Even though CNG vehicles have a strong demand, the government is currently facing possible challenges such as losing tax revenues and being asked to give similar tax breaks on other types of vehicles. Second, Microsoft is making a big move by investing $3 billion to expand its AI and Azure services in our country. A part of this plan includes training 10 million Indians in AI by the year 2030. And by committing this much money and effort, Microsoft is basically showing how important India has become in the worldwide AI strategy. Third, Zomato's share took a 5% hit after Jefferies downgraded the stock. Jefferies pointed to rising competition and pressure to offer deeper discounts as the main reasons behind its more cautious view of Zomato's performance. Well, that's all the news and stories I have for you today. I hope you found value in this episode and maybe learned something new from it today. As usual, I will see you in the next episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.